Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Today's jobs report signaled further evidence that demand for workers is moderating. The monthly reading showing that U.S. jobs posted the smallest gain in 6 months. Meantime, employment also weaker in the service sector report that was published after the monthly jobs read. This later report by the Institute of Supply Management, combined with the jobs data, the figures represent a moderation in demand that may restrain economic growth. This is why we're all kind of seeing the rate kind of re-rate, if you will, in today's trade.
We got somebody here with a unique perspective on a group of workers that really a few years ago always seemed in demand, though until they weren't. We're talking about those folks in the IT space. We welcome to the program Martha Heller, founder and CEO of Heller Search. It's an IT executive recruiting firm specializing in CIOs, CTOs, VP-level senior tech leaders, and executive tech talent. She joins us from Boston. Good to have you with us, Martha. You deal on a very senior level. I think we got to get that out there. What are you seeing when it comes to IT executives, which again, are up on the chain of command?
That's true. So thanks for having me. You know, I focus exclusively on the technology talent market. So this job report was not a surprise to me. We've been seeing massive layoffs in the technology sector for months now because these big companies, Microsoft, Meta, Google, they are reshaping themselves from IT providers to becoming AI businesses. So they are replacing teams of traditional engineers, technology leaders with data scientists, algorithm people, AI prompt engineers. So that is the primary reason we're seeing in the tech sector lots of layoffs. But we need to make sure we understand the difference between the tech sector and technology leadership talent. Every other company in the world that isn't a high-tech business needs traditional technology leaders. They're not ready to go full force into AI. So every time a Microsoft or a Facebook or Meta or Salesforce lays somebody off, that's good news for McDonald's and the NFL, and American Airlines.
That's so interesting you say that. Yeah, I talked to an employee at one of these firms just like years ago, and she was basically like, it's a little wild that people are still calling it the tech sector because everything is technology right now. It doesn't matter if you're in Silicon Valley. It doesn't matter if you have that tech DNA. You need to be in the tech space. But I am curious about where you're seeing movement right now. Are you seeing a reset because of this shift to AI, this idea that this is something, I mean, Carol and I were talking today earlier, JP Morgan out with a chat GPT-like service as of now. This is every company embracing this.
That's right. So you are exactly right. Software is eating the world and every technology is becoming a technology company. But at the same time, some companies like JP Morgan in the financial services sector, they've been upgrading their technology and technology leadership for years. Their product is data. It's always been data. So they're ahead of the game. But many companies have not been upgrading their technology. They've got data in all different places. AI cannot learn on something that is not a concentrated data set. So JP Morgan can do a lot with AI because they've been upgrading their technology. There are a lot of companies, even though they say we're a technology company, they don't have the architecture, they don't have the data science, they don't have the engineering to really run AI.
You know, Martha, I'm listening to you and yeah, we know that every company is a technology company, right? We've talked about this for years. And as you said, something like a JP Morgan, I mean, AI, not new. We all know that and stuff. It's just taking artificial intelligence, generative AI, LLMs, large language models. Like it's just a whole other level. And we're trying to really, assess as we continue to see the investment spend, how it changes our world. Some say it's going to be incredibly dramatic. Having said that, from your vantage point, here we are on a day where we see a job print that was actually softer than we've seen. And we're trying to assess what that tells us about, one, the labor market, and two, what that tells us about the economy going forward. So from your vantage point, what you are seeing with very senior level IT folks, what it says about the jobs market and kind of companies, what they are willing to spend on somebody maybe for those positions?
And I would say what we will see in that future is haves and have-nots. There will be companies that are changing what they're doing wholesale based on AI. They are becoming AI-driven businesses. Those folks, those companies, they're going to hire, they're going to grow, their cultures will change dramatically, and then there will be companies that will be left out of the AI boom because they're not doing all of those things. And so I think it's a big question mark. I think in companies that are getting ahead of AI, I think we'll see dramatic growth and dramatic change. We're also going to see ethical issues. We're going to see a lot of security issues. Okay. So I think it remains to be seen.
Hey, Martha, we're Bloomberg. We follow the money. We got to talk money here. What's compensation looking like? VP level, executive level, C level?
CTO,
Give us numbers here.
Sure. So I'm going to start with data scientists because that's the hottest new role going. Okay. A data scientist will cost about a base of $250,000. And then the variable comp on top of that, they could wind up being a $500,000 employee. But when you're seeing, CTOs of these huge media companies, they could be in the $2 or $3 million range. These are the compensation for CTOs, CIOs, CISOs, Chief Innovation Officer, Chief Data Officers has gone up a lot. I don't think you can get a Chief AI Officer for under $1.5 million in a public company.
Interesting. And everybody's willing to spend because they need them.
They must have them. I believe, and I'll just say a little, I know we want to talk about the money. The biggest challenge to AI, the AI revolution for companies, is their inability, senior executives, to understand the impact that AI could have. So you hire a $2 million CTO, you spend the money, you think it's worthwhile, but you haven't changed your culture, you haven't changed your business model. You want to do what you've always done, except have an expensive CTI run AI. That's not enough of a change. So yes, there are many companies willing to invest, but investing in that person is not going to get you there. You need the technology, you need the culture, and you need the smarts about how AI is going to change what you do.
All right. Well, interesting perspective. Our whole control room is like, hey.
Hey, data, science? I know those two things.
Chapter 2, perhaps. Martha Heller, thank you so much. Founder and CEO of Heller Search, as we said earlier, an IT executive recruiting firm. They specialize in things like CIOs, CTOs, all those senior level talent dealing with technology.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This week, pro-Palestinian protesters on U.S. campuses across the nation found themselves being arrested or shut down as colleges moved to slow their activities. Among the demands by activists, at least some of them, divestment from Israel and academic ties with the country, which brought up once again, at least for us, the relationship between money and academia. It's something we write about a lot here at Bloomberg. Bloomberg's Opinions, John Authors just today writing in a column that divestment has had some successes, but like the Israel-Palestine conflict itself, it is more complex than it looks. All right, we wanted to explore more, so let's get to our interview. We welcome Charlie Eaton. He's Associate Professor of Sociology at the University of California, Merced, joining us from there. He is the author of Bankers in the Ivory Tower, The Troubling Rise of Financiers in U.S. Higher Education. Professor Eaton, we are so delighted to have you here with us on Bloomberg Businessweek. You have looked extensively at how finance has played a central role in the widening equality that we've seen in recent decades, both in American higher education, but also really kind of more wider American society at large. Money in academia, not a new idea. What exactly, though, is the relationship today and with all its dimensions?
Yeah, it's not the same at every university. Not every university is Harvard or Columbia or Princeton or even the University of California. But our wealthiest universities now have endowments that are valued in the tens of billions of dollars, and that connects them to every corner of the global economy. A lot of that is via hedge fund and private equity investments. The wealthiest endowments now invest more than 60% or sometimes even more than 70% of their endowments with private equity and hedge funds.
I wonder how that's different now than versus the 1980s, because something that we've been talking a lot about, Professor, over the last few weeks has been what happened on Columbia's campus, for example, during the 1980s when the students were protesting apartheid in South Africa. How has the relationship between money and education changed between then and now?
Yeah, well, I mean, if you go back to the 80s, very few of the endowments, even the wealthiest endowments, were investing with private equity and hedge funds. It starts in the 80s. You know, a prominent story that was reported in the New York Times is that Tom Steyer, one of the first hedge fund founders, goes on to become a billionaire. He learns that David Swensen at the Yale Endowment is starting to use hedge fund investment techniques. And he spends a couple years trying to get David to invest in his hedge fund. He gets $300 million and he goes and he experiments in it. But David Swensen was nervous about doing that kind of investment because it was new and untested. But over the last 40 years, those endowments have grown through those kinds of endowments by an average of 10% average annual rate of return over the years. So that what the portfolio is invested in has really changed.
Well, what's most problematic about the relationship today? Is it just that it's heightened? Is it the amount of money involved, the financial entanglement? We just had a chart up showing, various endowments, over 50 billion at Harvard, 40 at Yale, 34 at Princeton, 34 billion, 13 billion, almost 14 billion at Columbia, 21 at the University of Pennsylvania. Real money. These are big money. And, when we inquire about them, many say, well, this is what's required at an institution of this caliber and this size, if you will, to attract professors in the facilities. But I do wonder, these are big numbers. And I just wonder the amount of money that's involved, this financial entanglement, what's most problematic about it in your view and from the research and analysis that you've done?
Yeah, there's two sides of it. I mean, one is, are the things that endowments invest in, are they consistent with the values of the university? So, questions like fossil fuel divestment have gotten at those kind of questions. But the other side of it is, what do the universities use the funds for? And if you look at the largest university endowments, they've gone up tenfold since the 1970s. Princeton's a good example because there's no law school, no business school there to complicate it. Their endowment's up tenfold, but they still enroll a similar number of undergraduate students to what they enrolled in the 70s. And what that means is, you go back to the 70s, they spent about $10,000 per year per student from the endowment to support university activities. Today, they spend about $100,000 per year per student from the endowment to support university activities. The question I ask is, would Princeton still be a world-class university if it enrolled twice as many students to serve more Americans from more walks of life and only spend $50,000 per year per student? So there's two sides of the question of, how should endowments be managed and what should the funds be used for?
I wonder about the demands that protesters are making today. There are lots of different protests happening or were happening on campuses around the country, but in some cases, like at Columbia, for example, calling for the school to divest from companies that support the government of Israel or do business there, for example. I'm curious if that type of action would even be possible for an endowment given the complexity of endowments today.
Yeah, well, Brown University and Northwestern University have recently suggested they can. The example of fossil fuel divestment has suggested that you can do some pretty complex divestment. I mean, I think we like to think of universities as innovative places, and we like to think of finance as an innovative sector that's a can-do sector where we can use technology and use innovation to be thoughtful about what we invest in. So, at a certain level, I think there is a kind of can-do thing. If you get a little bit more brass tacks, one thing is that particularly smaller endowments invest more of their portfolio with index funds and other passive funds. And there's a growing community of passive fund managers that use ESG, environmental, social, and governance principles for managing investments, and they use screens. There's over 300 such fund managers who screen out weapons manufacturers, for example.
Right.
So you do have private sector finance partners who you can work with to do this, and I think that's why some universities have expressed some openness to looking at what can be done and what should be done. I think the harder question is, what are your values? And how should you apply your values to your investing? It's not the technical question of how to do it.
Well, and I do wonder, going back to those endowment sizes and the importance that these schools hold in terms of having relationships with big donors, major donors, and making sure that they can maintain that endowment. But what does it do to kind of who has the power in an academic economy?
Yeah, no, absolutely. And another issue that your question gets at is the issue of transparency. Endowments have a culture and an institutional history of operating in the dark. They're managed by a chief investment officer with oversight from a board of trustees, and they often work with private equity or hedge fund managers who themselves value secrecy because that's part of the business. You're trying to beat the market. You're trying to use private information and your own smarts to outsmart the market, and you don't want others to know what your strategy is. So I think opening up your endowments to invest according to other principles, being more inclusive to students and community members who want to have a say in the endowment being managed according to their values, requires a shift in transparency in some of these practices that aren't how endowment managers have been built historically.
Hey, we have a couple, very briefly, yes or
We're
no.
gonna try.
Yes or no, because we only have 30 seconds left. Should the endowments be taxed based on your view, your research?
Yeah, I think that it depends on whether the endowment is being used sufficiently to serve enough students and students from all backgrounds. So, if a university uses its endowment to grow its enrollment, to serve all communities, then it should be tax exempt. If not, then I think there's reason to tax the endowment so that we can support students to go where there's not as much resources.
Is it tough to make sure that the right values are in place, especially when the board members are overwhelmingly, as you write about, drawn from the alumni who tend to donate most generously? And forgive us, but you've only got about 20 seconds, 25.
Yeah, I think it is tough, but universities are supposed to be places of innovation and ideas. And so I think reimagining the university and reimagining finance to be more inclusive and to give a say to our students and our community members is something that we're up to.
Professor, appreciate you taking the time. That's Charlie Eaton,
much.
Associate Professor of Sociology at the University of California, Merced. He joins us from Merced today. He's the author of Bankers in the Ivory Tower, The Troubling Rise of Financiers in U.S. Higher Education.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
A rare Rolex with a split-second chronograph sold for $3.5 million at auction in Monaco recently. It's a record price for the model. Carol, collectors are still willing to break records for rare and unique items despite a pullback in secondhand prices for Rolex, Patek Philippe, and Audemars Piguet watches that peaked back in 2022.
Well, speaking of the rarefied world of luxury timepieces, is the upcoming auction of 8 watches from the collection of none other than F1 legend Michael Schumacher. Christie's is set to auction them off, Tim, in Geneva on May 13th.
We've got with us Remi Guillemin. He's head of watches in Europe and Americas at Christie's, and he joins us here in the Bloomberg Interactive Brokers studio. Welcome, Remi. How are you?
Hello. Thank you so much for having me.
Well, thanks for joining us. We love talking timepieces here. First of all, everybody knows Michael Schumacher, legend in F1. How did Christie's get hold of these watches? Like, are you selling them on behalf of Michael Schumacher's family?
Yeah, well, our watch department since 2019 has had enormous growth, actually 77%. And, we've been able to kind of bring, fresh projects to the world of watchmaking and the auction industry, actually, by doing thematical auctions, an auctions that was dedicated to François Paul Jaune, for example. A watch that was called Legendary and Unique Watches, which was basically a single owner collection from Jean Todt himself, who was the former team principal of Ferrari in Formula One. Other single collections, and I think we've been able to we've been very fortunate to be contacted by the Schumacher family directly, and throughout the years work with them, and in the end they decided to place a few of their watches in our auction on May 13th in Geneva.
Let's get to the good stuff. What are these? Tell us what the timepieces are like and what's up for auction.
So actually there's a great diversity. The auction on May 13th, it's going to be so many watches, from Patek Philippe, Rolex.
How many are being offered?
There's actually 164 watches in the auction. There are 8 watches that belong to Michael Schumacher. So of these 8 watches, you have an incredible Audemars Piguet wristwatch, which was made uniquely for him. The dial was completely personalized. You have like his helmet, a Ferrari logo on the dial. Cool. Incredible watch. The watch was gifted actually by Jean Todt to Michael to commemorate one of his driving championships. So he won 7, so that was for the 6th. There's also a great François Paul Jaune wristwatch, Vagabondage wristwatch. Again, one of the iconic watches of François Paul Jaune. It's completely unique and made for Michael, again with great personalizations. So.
What's the market like for something where it's unique, one of a kind, Remi? And I am curious, when you talk about these watches, what's the expectation of how much they might go for?
Yeah, well, actually, the market for exceptional watches is really good, it's extremely strong, because we're in a place in the market, which, we're in the secondary market, but we're in the niche part of the secondary market, in the sense that we're selling watches that you cannot find anywhere else, right? So there's always demand, for these timepieces, and, we're really ideally placed. With regards to a prognostic, for like an idea of value, what we know so far is that we've had great interest, from Americas, from Europe, Asia, the Middle East for these timepieces. The fact that they have belonged to someone so iconic, and which is Michael Schumacher, and arguably the best Formula One driver, to ever be in the sport, it makes it a bit tricky to tell you exactly, to the dollar,
come
what
on.
the amount
You
will
guys
be.
are smart. You must have an idea.
But they
we're
were
talking like 200,000.
No,
millions.
So
We're talking millions,
for example, the Audemars Piguet wristwatch,
Yeah.
the estimate is 150,000 starting bid,
Right.
Okay.
Being the watch that it is, like, we expect that it will be around 400, 500,000.
Oh, okay.
But it could be more, due to the fact that the watch actually, and few watches in the Michael Schumacher collection, speak to both people who enjoy Formula One, who enjoy watches as well, because the watches themselves are actually great. Taking everything considered, to buy a unique wristwatch from Audemars Piguet, that was made by Audemars Piguet, it's already something truly special. But to have something that is unique from one of the greatest manufacturers of all time, that has belonged to one of the greatest Formula One drivers of all time, really great.
We've been doing a lot of reporting here at Bloomberg, our pursuits team, about the secondhand watch market, that it's been softening. So celebrity-owned watches still remaining strong at auction?
Yeah, because it's such a rare occurrence,
Yeah.
And it's true that, watches in the secondary market, some watches have been softening, but I think these are for the more commercial part of the secondary market, watches that are rare, but are still being produced, for example. And what we've been able to see in the past years, during COVID, for example, is that there was a scarcity in supply by the watch manufacturers.
Yeah.
Great demand from buyers who had excess savings, or, who just had the means to acquire a timepiece, for example. And in the end, you kind of ended up in this situation where everyone wanted watches, but the watch manufacturers in the primary market could not deliver them, so they had to go to the secondary market to acquire watches, and prices went up. That being said, watches that are truly rare and truly special. For example, we're selling a great Patek Philippe from the 50s in this auction.
This one's not related to
Michael Schumacher, but it's still, a hugely important watch. The first perpetual calendar wristwatch that was ever made by any watch manufacturer, allied with a chronograph and a moon phase. It's Patek Philippe who made it. The watch is valued 2 to 4 million.
Yeah.
Wow.
How old is it?
It's from the 40s actually, and
Pretty
it's
cool.
only one of 12 known.
Yeah.
Okay.
So that is something
So the
like
history, it's iconic
extremely
in
special.
that regard. Yeah.
And on top of that, when you're buying at Christie's, which is
Is that what you would call a really blue chip watch? Like, I'm curious about what
100
attributes make it something a really blue chip
100%,
Yeah.
100% blue chip item. And also there's something great. Patek Philippe, they are very well known, for their quality of watchmaking, but also for the extracts they keep. So if you buy a Patek Philippe from that era, we're going to do our research, to give you, our specialist opinion on the wristwatch. On top of this, Patek Philippe are going to make extracts which give you exactly how the dial was, how the watch was born, which dial did it come with, which movement, etc.,
Right.
etc. So it gives you complete transparency.
I'm interested in the marketplace because there are a lot of places to buy and sell watches right now, especially online places. Why is a traditional auction house the best place to actually go to sell a piece?
I think that it's because our network is great. We have offices all around the world. So we are, for example, our auction is in Geneva, but the reality is that it's global. We'll have people in the US that participate in the sale. We have people in Asia. We have people from all around the world. And Christie's is an auction house since 1766. So there's a reputational aspect, of course. There's also a great legal framework behind it, where if you buy a wristwatch, you will always be able to know where Christie's people are in case you want to resell it one day, right? If you buy a wristwatch at Christie's, you have a warranty on authenticity, which lasts for 5 years, and of course more, because the reality is we want people to be transacting in confidence when they buy
Right.
at Christie's. We even kind of pioneer in certain ways, to make sure that people's are very, or that clients are very at ease when they purchase or sell by using new technology. For example, this Patek Philippe that I was mentioning, the 1518 in pink gold, which is valued $2 million, starting bid. We're offering it with, of course, blockchain certificate, which is made by Watch Certificate, basically. And it's a certificate which, blockchain enables you to track exactly the history of the wristwatch,
Right.
who were the previous, what was the previous
Provenance,
ownership,
basically, yeah.
provenance, etc.
Yeah, provenance.
So, we, and then I think to answer your question about why Christie's, it's also because of the expertise. To have a discussion with an expert who can tell you in detail what a watch is very rare and special.
I'm going to put you on the spot, 20, 25 seconds. What brands are people seeking at auction most these days? And just real quickly, one or two.
Yeah, so if I had to answer very quickly, which I will, I would say Patek Philippe, Audemars Piguet, François Paul Journe. Then you have great independent watchmakers as well. A Crivia, for example, Crayon. The watch market has broadened so much now thanks to the level of passion and connoisseurship that people are interested in, more than just 2 or 3 blue chip brands. So it's
I feel like that's what our team has been reporting. Just it's the market and the options have really broadened out. Remi, thank you so much. Really
Pleasure.
fun, and we'll be looking forward to the auction
Likewise.
results. Remi Guillemin, he is head of watches in Europe and Americas at Christie's, joining us here in studio.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Tik Tok, everybody. Just about 18 minutes left in today's trading session. Getting ready to wrap
And
up.
that's going to be a week.
I know. Can I just say,
Say it.
this week has felt like 3 weeks.
And you were only here 4 days.
And I was only here for 4 days. Maybe that's why it felt like 3 weeks.
I
but-
agree with you completely.
But just right, some
By
of the...
Wednesday, I was like, what? How is this still... how was this only
That was
Wednesday?
a Fed meeting,
I know,
a
it
Fed
was a Fed
decision,
meeting.
right?
I know, yeah.
And there were a lot of I don't know. There was
Amazon
like
earnings
this churn.
Tuesday, jobs today. I mean, there's a lot.
Yeah, right?
Yeah, that's what it felt like.
All right, so here we are, and we're setting up for another gain for the S&P 500. That would be 2 in a row, as Abigail reminded us, after 3 down weeks for the S&P 500. We understand the trade today, as we've seen, really a rate reset along the U.S. Treasury curve after that softer than forecast jobs report.
For a drive to the close, we got with us Amy Magnotta, Co-CIO at the Registered Investment Advisor, Ategenos Capital. Amy joins us from Pennsylvania. Amy, how are you?
Great, thanks. How are you?
We're doing well, thanks. Hey, so how are you looking at everything that happened this week and also moving forward, given that we saw pretty much a rates reset today after that softer than expected jobs print?
Yeah, I think we had really become a little bit more cautious back in the beginning of April after really strong run in equities since November, and then investor sentiment had reached pretty elevated levels. So there was a lot of expectations, I would say, built in. So we were a little cautious coming into April, and we did see some of that, a little bit of a market correction. And as you said, I believe it's just kind of this repricing of Fed expectations for what the Fed's going to do. So a few weeks ago, it was a couple of higher than expected inflation prints, and that concerned market participants that rates would be higher for even longer. And now with the softer jobs report today, a little bit of a reset there now, thinking that we will see some rate cuts this year. And the market's pricing in, I think, 2 rate cuts, September and December. So kind of a reset of expectations, as you said.
Hey, Amy, what are the questions you're getting from some of your clients, your investment clients, and what they want to know and what they're thinking about in this environment, and where they are thinking, okay, here's where I want to be, or where I feel comfortable with exposure, here's where I don't?
Just with the strong performance we've seen in some of the large cap growth indices last year, a lot of investors are concerned about, has that run its course? And for us, we always recommend, a more diversified portfolio. Certainly, we're going to have biases and over and underweights, but we think investors should be a little bit more diversified today. I think investors are concerned about rates and what that means for their fixed income portfolios. And also just, given the strong run in equity markets, we always get, kind of, is this the top? And then as we get a little bit closer, a few months from now, I'm sure we'll be getting a lot of questions on the election and what that might mean for markets.
All right. So how are you steering them? My understanding is you like the small cap space. We know the Russell, if I look at it, the Russell 2000 is pretty flat on the year. Is that because there's more value to be had and you see more upside?
Yeah, that's correct. So we like small caps here. We think valuations are very attractive relative to large caps, and then also relative to small caps' own history. But I think one important note is that we like active management in small cap right now. So we do use a blend of passive and active managed strategies in our portfolios that we recommend for clients. So we do like active in small cap. If you look at the Russell 2000 index, we have a very high percentage of those companies are non-earners. We want to be, we think active managers in this environment today, where there's greater dispersion, have really can add value, especially in that small cap space where it's a little more inefficient.
Amy, where do you not want to be right now? What do you want to stay away from?
We have been, I would say, where our underweights are, have been in on the international space. So we still own international, but we do favor the U.S. over international. And then within international, we've been underweight Europe. We favor Japan and emerging markets. And so we've been really staying away from Europe. Also in the fixed income space, we're shorter duration. So we're kind of avoiding long duration today, given certainly have a move in rates in the last few days. But we still think there's a lot of volatility there, and that long-term rates could stay a little bit higher. So we've been a little bit more flexible in fixed income and shorter duration. Plus, you're getting a nice yield on short-term securities right now.
Interesting. It's interesting. So I do also think about politics. Like you said, that later on in this year, you expect you're going to get a lot more questions from your clients. We've had a fair amount of folks, I feel like, come on and say it doesn't matter. Election year is usually good because candidates are out there promising everything and everybody gets pretty excited. But how are you thinking about the election, the outcome, and what it could mean potentially for financial markets and the investment environment?
I think what we typically see leading up to the election is that the incumbent president will try to promise a lot or try to get some things done in order to win some of those votes. I think it's a little bit harder in this environment to get anything done in Washington, as we know. So I think there'll be maybe less of that than we've had in previous cycles. But we have seen some things with the student loan forgiveness and other things. But I think typically the outcome does not matter. There's the volatility leading up to that, uncertainty about what proposals might make it through. But typically there's a rally post-election in the back half of that year, regardless of the outcome. It's more of a certainty. The market does not like uncertainty.
Do you see this year being any different, though? I mean, this is kind of a bizarre year.
It is, and I think if there's one year it probably could be different, it might be this one.
Yeah.
We also have the tax cuts expiring at the end of 2020. So I think that as we see the proposals for how that might impact, that could impact markets in the short term. We could see some volatility surrounding that, uncertainty. But typically we get that relief rally regardless. And then once that president is in office, we would see there'd be some really... You'd have to really understand the proposals and what could actually make it through Congress.
In terms of, investment cycles as they go, and it's kind of interesting, kind of some of the swings we have seen in terms of expectations from Fed policy and the outlook or the recession that was being called for so long. But when you look at the environment today, does it feel like you have more visibility? Do you feel more confident, or do you feel a bit more nervous? And just got about 30 seconds.
Yeah, we're pretty confident. I would say in 2024, low probability of a recession. As you said, people have been calling for a recession for probably the last 18 months. We think the inflation report today is soft landing-ish for sure. But I think the key thing will be inflation. If inflation can come down in the next few months, we saw wage growth was slower in the employment report. So in the last 3 months, wage growth has been about a 2.8% annualized basis, and that's kind of more in line with the Fed target. So I think growth is still pretty solid as long as we can get inflation to come down a little bit, and the Fed can recalibrate monetary policy. I think 2024 is we're pretty positive on that.
All right, some optimism. Hey, listen, so appreciate it.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.